As we continue to navigate the complexities of modern finance, a staggering reality emerges: $1 trillion in cash hoarded by individuals and institutions around the world. This monumental sum has piqued the interest of economists, investors, and policymakers alike, sparking intense debate about its implications for the global economy. The sheer magnitude of this cash reserve is awe-inspiring, with over 30% being held by just 3 countries: the United States, China, and Japan. The United States, in particular, boasts an impressive $430 billion stash, followed closely by China's $270 billion and Japan's $230 billion. These figures are not just numbers, they represent a significant portion of the world's wealth parked in low-yielding cash accounts. The reasons behind this phenomenon are multifaceted. Low interest rates, implemented to stimulate economic growth during times of uncertainty, have rendered traditional savings instruments unappealing. Coupled with rising concerns about market volatility and inflation, many investors are opting for the perceived safety of cash. This trend has been particularly pronounced in Asia, where governments' own cautionary stances on economic instability have contributed to a cash-first mentality. But what does this mean for individuals who've chosen to sit out the market? The answer is far from comforting. As interest rates linger near historic lows, savers are sacrificing precious returns on their hard-earned money. Consider the opportunity cost: if $1 trillion was invested instead in bonds or stocks, it could potentially generate millions of dollars in additional revenue each year. This brings us to a pressing question: can you afford to stay in cash? As we stand at the threshold of 2023, a peculiar phenomenon has taken center stage in the world of finance. The global cash hoard, once a mere trickle, has swelled to an astonishing $1 trillion. This colossal sum represents a stark departure from the conventional wisdom that cash is king only during times of economic turmoil. Instead, it highlights a more nuanced reality, one where investors, institutions, and governments alike are grappling with the consequences of low interest rates. According to recent estimates, over 30% of this $1 trillion cash is held by just 3 countries: the United States, China, and Japan. The sheer scale of their cash reserves is a testament to their economic prowess, but also raises questions about the efficacy of their monetary policies. The U.S. Federal Reserve, for instance, has been accused of fostering a culture of cash accumulation, with its benchmark interest rate hovering around 1.5% since 2020. This phenomenon is not unique to these 3 nations alone. Many other countries, including Canada, Switzerland, and Australia, have also seen significant increases in their cash reserves over the past year. The exact reasons behind this trend are multifaceted and complex. Some attribute it to a natural response to low interest rates, which makes saving and investing less attractive. Others point to the increasing volatility of global markets and the corresponding desire for liquidity. Whatever the reason, one thing is clear: the world has entered uncharted territory in terms of cash accumulation. As we navigate this new landscape, one question looms large: can investors afford to stay in cash? The answer, much like the $1 trillion question itself, remains shrouded in uncertainty. As we delve deeper into the world of cash hoarding, it's essential to examine the key developments and evidence that have contributed to this phenomenon. The $1 trillion mark is a testament to the growing distrust in financial markets and institutions. According to a report by the Bank for International Settlements, cash reserves held by central banks have increased significantly over the past decade, with some countries holding up to 30% of their GDP in cash. One notable example is China, which holds an astonishing $3.2 trillion in foreign exchange reserves, mostly in US dollars. This has led many to speculate about the country's intentions, with some experts suggesting that it may be a sign of currency diversification or even a hint at a potential shift away from the dollar as a global reserve currency. Another factor contributing to this trend is the prolonged period of low interest rates and economic uncertainty. In an environment where returns on investments are scarce, many investors have turned to cash as a safe haven asset, seeking protection against market volatility. This has led to a surge in cash inflows, with some banks reporting a 20% increase in deposits over the past year alone. The data is unequivocal. Since 2010, the global cash hoard has grown by an astonishing $700 billion, with the majority of this growth attributed to just three countries, the United States, China, and Japan. This trend is unlikely to reverse anytime soon, given the persistent economic headwinds and the ongoing search for safe haven assets. The implications of this phenomenon are far-reaching, with some experts warning about the potential risks of a cash-driven economy. As we explore the consequences of this trend, it's essential to consider the impact on global trade, investment flows, and even monetary policy itself. As we delve deeper into the $1 trillion question, it's essential to consider the underlying drivers behind this unprecedented accumulation of cash. With interest rates at historic lows and economic uncertainty lingering on the horizon, investors are seeking refuge in what they perceive as a safe haven asset, cash. This phenomenon is particularly pronounced in countries with traditionally low savings rates, such as Japan, where the government's efforts to boost consumption have been largely unsuccessful. The United States, on the other hand, has seen a surge in corporate treasuries hoarding cash, driven by tax policies and a desire for liquidity amidst economic volatility. According to a recent study, nearly 40% of S&P 500 companies now hold more than $1 billion in cash reserves, up from just 10% in 2007. This trend has significant implications for corporate governance, as boards grapple with the opportunity costs of holding such massive sums. China's reserve buildup is also noteworthy, with over $3 trillion in foreign exchange holdings, making it the largest holder of dollar-denominated assets worldwide. Beijing's motivations are multifaceted, with a desire to stabilize its currency, accumulate strategic reserves, and potentially exert influence on global markets. However, this vast accumulation of dollars has raised concerns about the sustainability of China's economic model. As we examine the $1 trillion question through the lens of real-world implications, it becomes clear that cash hoarding is not just an investor phenomenon but also a symptom of broader economic issues. Central banks' quantitative easing policies have created a culture of risk aversion, where investors are prioritizing preservation over growth. This has far-reaching consequences for global capital flows, asset prices, and the overall efficiency of financial systems. In the following segment, we'll explore the potential risks associated with cash hoarding and how this phenomenon may impact economic stability in the long term. As we've explored the $1 trillion cash hoard amassed by nations worldwide, a pressing question arises: can these governments afford to stay in cash? The answer is far from straightforward. Low interest rates have made holding onto cash a costly proposition, yet many countries continue to stockpile it. This paradox highlights the complexities of modern monetary policy. One key consideration is inflation. Despite central banks' efforts to stimulate growth through quantitative easing and zero-interest policies, the specter of inflation remains. In an environment where prices are rising, the value of cash reserves can erode rapidly. For instance, in Japan, the Bank of Japan's massive cash reserve has dwindled in value due to low interest rates and persistent deflation. Another critical factor is the opportunity cost of holding onto cash. With interest rates hovering around zero, governments forego potential returns on their vast cash reserves. This lost revenue could be redirected towards vital public services or infrastructure projects. In the United States, for example, a $1 trillion cash hoard represents an estimated $40 billion in foregone interest income annually. The sheer magnitude of these cash reserves also raises questions about their management and security. Who safeguards this enormous wealth? How are these assets invested, and what risks are associated with holding such vast sums? The opacity surrounding central banks' decision-making processes adds to the mystery, fueling speculation about the true intentions behind these massive cash accumulations. In light of these concerns, one can't help but wonder, are governments prioritizing